This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
The European Union plans to ban Russian LNG imports into the bloc a year earlier than envisaged as part of a 19th package of sanctions against Moscow, EU officials said on Friday, a change that follows pressure from US President Donald Trump. The revenues from fossil fuels sustain Russia's war economy. We want to cut these revenues, said European Commission President Ursula von der Leyen, as she announced the proposal, which requires unanimous approval from EU governments. So we are banning imports of Russian LNG into European markets. It is time to turn off the tap, von der Leyen said.
Oil prices dropped on Friday as worries about large supplies and declining demand outweighed expectations that the year's first interest rate cut by the US Federal Reserve would trigger more consumption. Brent crude futures settled at $66.68 a barrel, down 76 cents or 1.1%. US West Texas Intermediate futures finished at $62.68, down 89 cents or 1.4%. Both benchmarks rose for a second consecutive week. Oil supplies continue to remain robust and OPEC is reducing its oil production cuts, said Andrew Lipow, president of Lipow Oil Associates. We haven't seen an impact on Russian crude oil exports from sanctions.
Moving on to the top news in the energy sector.
The price of Russia's Urals crude oil for delivery to top buyer India is rising despite growing sanctions risks as Ukrainian attacks on Russian ports and pipelines and tightened sanctions prompt concerns about supply, four market sources told Reuters on Friday. Ukrainian drone attacks disrupted exports in September and heightened risks of production cuts, forcing Russia to send oil to other Western ports to mitigate the impact. The discount on October loading Urals crude has narrowed to $2 to $2.50 per barrel against dated Brent from $3 in September, four sources involved in Russian oil sales to India said, as Western sanctions pressure was intensified.
Iraq's attempt to ease its chronic power shortage with gas from Turkmenistan routed through neighboring Iran has failed under U.S. pressure, leaving Baghdad scrambling for alternatives to keep the lights on. Oil-rich Iraq has struggled to provide its citizens with power since the 2003 U.S.-led invasion that toppled Saddam Hussein, forcing many to rely on expensive private generators, causing economic hardship and sparking social unrest. A deal first proposed in 2023 would have seen Turkmenistan export gas to Iraq through Iran, which lies between the two countries. Under the swap deal, Iran would receive the gas and supply it to Iraq, but this risked violating U.S. sanctions on Tehran, requiring Washington's approval. Next, we have the top news in metal markets. Iron ore futures advanced on Friday, ending the week higher, buoyed by strengthening steel demand and pre-holiday restocking in major consumer China. The most traded January iron ore contract on China's Dalian Commodity Exchange rose 0.81% to 807 yuan and 50 fen, $113.54, a metric ton. The contract ended the week up 0.88%. The benchmark September iron ore on the Singapore Exchange was 0.27% higher at $105.55 a ton as of 0716 GMT, though it is down 0.14% for the week.
Copper prices rose on Friday on signs of improving demand from top metals consumer China, where buyers are looking to build up their inventory ahead of a long national holiday. Benchmark 3-month copper on the London Metal Exchange was up 0.4% at $9,980 a ton by 16:01 GMT. The metal is down 2% since hitting $10,192.50, a 15-month high on Monday, as traders booked profits following the U.S. Federal Reserve's rate cut on Wednesday. The Yangshan copper premium, which reflects demand for copper imported into China, rose 1.8% to $57 a ton on Friday.
We will now look at the top news in the agricultural sector.
S&P Global Commodity Insights projected on Friday that U.S. farmers would plant 94.5 million acres of corn next year, down 4.3% from this year, and 84 million acres of soybeans, up 3.6%, according to a report from the firm seen by Reuters. Farmers are struggling to turn profits on both crops this year because supplies are ample and China, the world's biggest soybean importer, has not bought U.S. soy from the autumn harvest amid its tariff dispute with Washington. Growers will plant their 2026 crops next spring, and S&P Global's report said there was more uncertainty than normal around its early estimates due to ongoing trade negotiations.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.